Well, before we start the panel, there's enough people here where I just wanted to make a comment that something I've observed a couple of things today. That started at the beginning of the day, and we see it as we enter into the last session. And those two themes are one about education, and the other theme is about collaboration and also with partnerships as well. So we heard this, with some of the early panels about people playing consultative roles, where someone who works at an exchange, might give some thoughts about sales and distribution for an issuer, as well as also compliance and regulatory matters. But at the end of the day, you can only go so far, but then ultimately you have contacts. So here's the person I know from such and such legal firm, or from such and such market maker AP as well. And so as we have these conferences, I think about the industry and how it's evolved over the last 20, 25 years. I remember my first conferences, where I met people, contacts. We've all changed different roles within the industry as well. I mean, personally, I've been in the market making space, the issuer space, the exchange space, and then the regulator as well. And throughout that entire time, I've been able to leverage a lot of my contacts, for their thoughts, their perspective on these topics. And so, I mean, before I introduce this next panel, really, if you think about how quickly this industry is evolving, people have said we're in the third or fourth inning for the last 15 years. So we're kind of stuck in this, call it Groundhog Day of fourth inning. So really, the point I'm trying to make here is that it's great to see you here, that we can learn from each other, collaborate. The ETF industry is known for collaboration because at the end of the day, as you see the panelists talk about how they do their jobs and how they support their clients, it's all about working together and really meeting the needs of your clients in an ever-changing, innovative work environment. And so I'm going to introduce the last panel by basically saying that we're going to touch on indexing, the future of indexing. We talked about custody. We tried to make custody sexy again. I think we did it. So ultimately, the reason why I mentioned that is that the industry is innovating. We're no longer at a 1.0 of custody. We're no longer at a 1.0 of indexing. We're at a 2.0 and a 3.0, which means that we have to keep evolving to know the new space, work with each other, collaborate, educate, and we're going to be having the same dynamic in 5 or 10 years, which is, hey, I can help you here as it keeps innovating. And here are the people that you need to talk to so that you get a great experience in terms of how to make your business successful. So just wanted to, I just wanted to make that, observation and kind of words of wisdom before I hand the mic over to Paul.
Thank you. Paul Ellenbogen, Head of Research at Graffinity, and hello again to some of you. Our panel is Shaping the Future of Indexing, and I'd like to begin by asking our panelists to introduce themselves, and then we'll get into our questions. So maybe from the outside in.
Wonderful. Can you guys hear me okay?
I don't think that's one's.
I don't think this one's on. There you go. There you go. All righty, we're in business. Hi, hello, my name is Heather McGee. I'm the Chief Executive Officer at 17 Asset Management, a firm that has been built to create products that align to the 17 Sustainable Development Goals. So we have products across asset classes. We have private alternatives in the U.S., in the Caribbean, and we're building an Africa infrastructure strategy now. We also have liquid model equity portfolios that are actively managed, and we also have a suite of indices that we've built in development with our partners here at Syntax, which my comments will be focused on today. My background was in politics for about 5 or 6 years before transitioning to finance about 10 years ago, and I really love this industry. I love that I get to be here today to tell you guys about our products. They might be a little bit new to you as they're just getting launched now. So I'll turn it over to John.
Thank you, Heather. Jonathan Chandler, Chief Operating Officer for Syntax, and I've had the pleasure of working with Heather in building some of those indices that she just mentioned. And as a firm, we both collect and organize a bunch of information about company classifications down to the revenue stream level. And then we deploy those in indices, both ones that we license to traditional institutional players like ETF issuers, and ones that we are now getting into for the direct indexing space for the more downstream RIA crowd. So really excited to be talking with you all today about where I see indexing going.
Hello, everybody. It's Roby Montoni. I'm the Chief Operating Officer at Mercube. Mercube is a young, 5 years old, we just turned 5 years old, fintech company that is focused on indexing and rules-based strategies. So the belief is that with the growth of indexing or rules-based strategies, passive in pedestrian terms, with the growth of it and the ingenuity and the transformation of that space, technology is the answer to simplify what can at times be a very complex space to navigate because of the amounts of data that you have to consume, the complexity of the data that you have to clean, etc. And so our goal is to simplify rules-based investing through the use of technology. And over to you.
Hello, everyone. I'm Ryan Giannotto, Manager of Equity Index Research at London Stock Exchange, FTSE Russell. And really what my focus is developing, designing, and then supporting new index launches, new ideas and the methodologies, and capturing that unique essence of IP that you may want to bring to market or already have in market and want to update, refresh, and stay competitive. And the world of indexing, it's always I still think we are early innings. It's just as was said before, it's just I think the next wave really is taking active strategies and getting a 90% solution that is cheaper, more effective, and more scalable, open to more people. And that's really, I think, going to be the project for the next decade.
All right, with that, some questions, and this is meant to be, I know it's us and then the reception, so I'm going to try to keep this lively, even get to questions a little early, maybe get you to the reception early. So before we get into the future of indexing, looking at the present, and so if you're just right in the present, I looked at index ETFs in the large blend Morningstar category, so the core of the US equity market. That's $2.8 trillion. And 3 of those, which I'm sure you know which 3 those are, have over 500 billion in assets each. So a cynical person might say the future of indexing looks like the present of indexing, except more so, meaning those will be, and this has been said, at some point, trillion-dollar ETFs, which would leave a lot of people in lurch. So I'm going to guess that the panelists here don't think the future of indexing is more of the present. And if they don't, tell us what you think the future is.
I'm happy to jump in there. So I think the real question is, who is the customer of an index? And at the end of the day, it really is the client, but it's the intermediary that helps a client understand whether or not, or determines what the client needs and creates the strategy for them, whether it be identifying an ETF or creating an index for them. And what we see is indexing being a tool for that intermediary to really refine the strategy for their client, really customize a solution that meets their needs. And we don't see that going anywhere. And if advisors aren't working to find ways to bring this value add to their client base, they'll be disintermediated by platforms probably pretty quickly.
Yeah, I mean, I think, first, I agree with everything that Heather just said. To the sort of entrenched nature of the S&P 500 or MSCI ACWI or the Russell 1000, those are not going anywhere. I think as core positions in many investors' portfolios, and in particular in the ETF wrappers, I don't see a whole lot of innovation happening on that front, but I think there are a ton of investor needs that are not well addressed by only those core solutions, and that's where I think all the innovation's happening. Some investors need yield. Some investors have a preference for a certain theme or certain religious or environmental or social values that they want to see expressed in their investments. And that can be done in a passive and rules-based and indexed way. And I think I don't want to steal Roby's thunder on this because I agree with what you were saying in your intro as well. I think that's a lot of where indexing is going by the way of the use of technology.
I don't know. I disagree. I think that even in these core product areas, there's lots of room for innovation. I think one area is it's really been the derivative bonanza that we've been seeing. Basically, it used to be as an afterthought. How do we incorporate derivatives into whether it's swaps, options, futures into these core positions? Now we're seeing that that is from the very initial parts of the discussion. Much like sustainability in Europe is part of the core. It's just that's where every conversation starts. We're not quite there yet with derivatives, but it's very close to there. If it's not the first item we speak about in America, it's probably the second or third. And that's really exciting because you can then do a whole bunch of really interesting things. You can carve up your risk factors. Not even just defined outcomes that we've seen, really explode onto the scene. But and that's a great evolution of core markets, and taking from other areas of finance, that we might see with structured products, mutual funds, and taking that to ETFs. So I really do think that's just one area, one example of how even in core markets we're going to see a lot of innovation.
I'm just gonna play Switzerland and agree with everybody, right? So I agree with
Oh.
you. I agree with them. I do believe that the S&P 500, the Russell 2000, the MSCI, IFA, ACWI, whichever one, they are the foundation of our economy, right? Of our markets, and so people are going to continue. There's going to continue. To be a tremendous use of these assets because they are the foundation. And then we will see a lot of innovation around and within, right? A lot of it, I think that right now the big indexers, of course, are facing all of these, little other indexers that are coming up because not everybody needs a brand, which can be expensive, or somebody wants something that's a little bit different. So to me, those are always going to be there. They're always going to be the main component of our investing, but there's going to be a lot around it too.
And I'm not actually sure we do disagree that much, Ryan, because I agree there are very interesting things happening with embedded derivative products, and I think that'll come up probably later in this panel. I'm just not convinced that those are going to take assets from the traditional core products that don't have the embedded derivatives. I think you might see a lot of new inflows going there, but I wouldn't bet on SPY AUMs going down anytime soon.
All right, I'm going to come with another question. One of the themes that I heard, at least, several times today is, yes, you should open an ETF, but there are certain things that probably shouldn't be in an ETF or won't work in an ETF, or you should at the very least talk to somebody before you assume you can just take it and put it into an ETF. So I'd like to do a twist on that. Are there things that shouldn't be indexed, in your opinion?
I'll start off on this one if you don't mind. I think, to my mind, the core of indexing is being able to follow a consistent and transparent rules-based methodology. And so if you have a strategy that relies on some guy waking up on one side of the bed and having a gut feeling about a stock, you can't index that, right? Outside of that, I don't really see a limit. I think the number of asset classes, as long as you have good pricing data, doesn't necessarily have to be real-time pricing data like you get for listed equities. But private instruments, crypto tokens or other digital assets, maybe even real estate or commodities in an ETN structure. I guess that's not really an innovation now, but I think those are all ripe for embedding inside a rules-based and transparent kind of index.
Yeah, I would add to that the areas that have not been indexed today are because there's some structural issues that prevent indexation to occur. So, for instance, private equity has been one of the areas that has not been indexed before, and having spent many years in indexing, that was always the first question that we would receive is, do you have a benchmark for private equity assets? The reason why there isn't, or they are starting to to come up. But the reason why there wasn't one is because the data wasn't there, because you don't have a regulated or a mandatory disclosure rules. And so the data becomes unavailable, or it could produce results that are not true to the strategy. So I believe that the only reason why something shouldn't be indexed is because there is something structural that prevents it from being indexed.
No, that's a really great point. I think the two key criteria is it has to be liquid, as she was just describing, but it has to be trackable. It has to be traded frequently with live pricing, and it has to also, third, be able to handle scale, because that's just a potentiality that ETFs bring. You're not going to see this, you're not going to see asset growth like you do in ETFs in other areas of the market. It's just inherent to the nature of the product that literally anyone can go and buy it at any market hour time. So those are the three things: scalable, it has to be liquid, and it has to be trackable.
As far as our indices are concerned, we are purely equities. We are innovating within that through the alignment of the revenue of the underlying securities mapped to the sustainable development goal in which the stock is a part of the index for. So if you're trying to solve to clean water, your underlying securities are going to have revenue that ties to products that are generating either clean water or cleaning the water or protecting the water or what have you. And so I think even within the traditional way in which we think about indexing of purely securities that are liquid equities, there's a lot of innovation still happening there as well.
And a lot of better data sets that are coming out that allow index creators to build indices around concepts. I don't think that revenue level look at sustainable development goals could have been done 15 years ago.
Absolutely not. Absolutely not. And a lot of the SDGs do have components that overlap with your GICS sectors, and so you can map it to your model portfolio theory pretty easily, but a lot of them are much more complex. So you're talking about global challenges that you're trying to solve by directing capital accordingly. You need this really robust data, and that's one of the reasons we love Syntax is their taxonomy and their alignment to revenue to the SDGs. They've done a lot of work. We've collaborated on that a lot as well, and now we have a really innovative product that is still very vanilla as far as what's in the index. It's all just equity securities.
Okay, so I'm going to date myself. Once upon a time, there were indexes, and they were constructed so that active managers, who were the rock stars, could beat them. And it wasn't really a question of whether they would beat them. It's who would beat them by more, who would beat them on a risk-adjusted basis, and so forth. So let's say that's not true anymore, and we now have a proliferation of indexes, up to including sort of personalized indexing. Given that, does it make sense to think of indexes as passive investing? Because that was always, those things were kind of synonyms. What is an index fund? It invests passively. What is an active fund? It invests actively. Now we have lots of indexes. Are they truly passive?
I can take that. I would say that passive is almost like an outdated word, right? It's there's very little passive in passive to begin with, right? 15 years ago, I remember I had to do a class for a group of pension trustees that were just at the beginning of their career as a pension trustee, and the presentation was, what is an index, right? And the decision between, when you're investing was, first you have to decide if you're going to do active or passive, and if you decided that you wanted to do passive, you had to see if it was available in a passive vehicle, because 15 years ago, passive was $2 trillion. Today is $17 trillion. So there is very little about passive. I think that passive is becoming more like rule-based, and it's very dynamic, and it's there's so much creativity that's going into passive that I like it. I like to call it rules-based. I don't even call it passive anymore.
Are you saying that passive is passe? I think that's a great headline.
Okay, you heard it here first.
That's what I'm going to write tomorrow. Okay.
You're in the new Wall Street Journal.
Yeah, there we go. Passive is
passe.
passe. That's what we're taking away from this. But even if you look at the largest passive vehicles like the S&P 500, they run their stock selection process like a New York condo approval board. Why do companies get in? I don't know. They don't know. No one can tell you. That's active. And
Well,
yes, yeah. Yeah, they do. They do. Even the audience is voting. The audience is voting. So
I spent
yes,
many
yes.
years at S&P, so I do have a soft spot for the S&P 500. But it has been called
Many
the largest
investors do.
hedge fund in the world. But
Yeah.
there is a lot of strategy. I mean, a lot of discipline to the way that they manage the S&P 500. So.
And I think also there's two levels of this active versus passive. One is what is the index provider doing, and how are the rules that they're crafting are those rules that are very complicated, that feel like an old school active approach, even if it's implemented in a rules-based way, or is it, we're taking the largest 500 companies by size with a liquidity screen and calling it a day, which is, to be clear, not what any of the large index providers are doing. It's a lot more complicated than that. But there's another level to this, which is what is the fund or portfolio manager doing, right? Are they just fully replicating blindly, or are they applying some techniques in order to add some alpha around the edges? And I think that's this new alpha paradigm, or new active paradigm in a lot of ways. Not every active fund is that, and there are a number of passive funds that literally can't replicate their index, especially on the fixed income side. But I think there is a lot happening with this sort of terminology around active and passive that conflates whether the index is active or passive, or the fund is active or passive.
Yeah, and I think just to take that a little further, the way we think about it is maybe using an analogy of a restaurant and being a chef in a kitchen. Your index can be an ingredient to a meal, or it can be the meal. It depends on who is using it and what are they using it for and what are they trying to solve to. And so as index creators, our job is to ensure that whether the ingredient is on the menu direct, or if it's part of a broader offering, that what we've brought to the table is organic, that what we've brought to the table is best in class of whatever it is that the objective is aligned towards. And so we see in some cases people want sovereign wealth funds or major institutions want to just have exposure to U.S. equities aligned to the themes that we manage towards, and some people may just want to use it as a benchmark. How it's used is up to the chef in the kitchen. We're the ingredient supplier.
I would just make one more comment. The majority of traditional indexes, so the ones that have been around for longer than I have a quarterly rebalance and a yearly reconstitution. Today's indexes are rebalancing intraday. So that's what I mean when I say there's very little passive in today's indexes, when they're rebalancing intraday.
So one of the arguments for, it's a sort of classic Jack Bogle argument for indexing, is it doesn't always have the best performance, but when you throw in the cost of active management, and this is even apart from or taking away distribution fees and sales loads and something like that, it doesn't really matter whether funds beat the index, because if they don't beat it by enough to cover the expense ratio, you're in a sense worse off. So you might as well index. And of course, part of the charm of indexing has been it's cheap. It's 3 basis points, it's 2 basis points, it's 1 basis point, or it's free, even though we know that it's not quite free. So how do you think about something like price? If indexing is different than it was before, presumably it's more expensive, more difficult, more valuable. How do you think about price for something that's an index fund but is not SPY or the like?
I think price is been changing as we've seen from kind of low to high premiums, and now we're coming back down, but still higher than was kind of market standard a number of years ago. I do think that is because of the cost of the data, of the technologies, of the different participants that are involved in the development of an index and the managing and the rebalancing. There's and in our case, we still try to work to price our index offerings quite low, because we do want to ensure that they meet that threshold that people have as far as their whether or not it meets the overall cost of whatever they're trying to use the ingredient for, if you would. And so we know that any advisor or manager who's going to leverage the indexes that we have on their shelves are going to put a premium on it. So you have to ensure that you're priced low enough that the overall cost is going to be appealing to your client.
Yeah, and it's really going to depend on what kind of index we're talking about and how much scale that can get, because there are efficiencies that come. When you're talking about when SPY, the sheer size of the assets behind that allow Fidelity to price that basically at break even, right, or not even. It's probably a loss leader. I think the input data that Heather raised is one of the key determinants, right? If you're building a complicated index that needs complicated data sourced from lots of different places, that has to be reflected in the price that's charged from it. But with the use of technology and the ability to scale these much more cheaply than when you need to hire a workforce of humans to go out and calculate the index by hand, you can bring those costs down to a level that's lower than most active management, even if it's a level that's higher than what you get from a very plain vanilla index.
Yeah, I would say price is probably one of the things that scares me a bit, because with the innovation that's coming, so the use of derivatives, the use of the mixing of IPs from different exchanges, everybody is coming into the IP game, right? So now you have anybody, for instance, industry code. If you have, you're no longer a data provider, you're an IP provider, and IP is expensive, right? And so all of these, the cost of this data, or the cost of access to these data sets, is becoming more and more and more expensive. And I know it because I see the bills. And that is going to potentially have an impact on a game that's really been a race to the bottom in the passive indexing space, but that is probably going up again a bit because of the cost of access.
I think somewhat the discussion around price is somewhat missing the point. Prices are low where there's lots of competition for the funds. And if you're going into an area where there's not a lot of competition, we see prices, funds coming online now at 1% annual fee, which is quite insane. And but if there's not a lot of competition, there's no impetus for the prices to come down. So I don't necessarily buy into the argument, that if you're doing this, you're in this range of bips. Or if you're in that range, well, okay, now you can charge between 40 to 60. It's, are you doing something that is outside the competitive arena? And is there investor demand for it? And are you insulated enough yet from outside competitors? That's what I think is so interesting, is that there was this race to the bottom based on industry competition alone. It's not like the SEC came out and said you have a target for lowering your fund prices each year. No. It was just raw competition that just unleashed all these billions of dollars in savings. And so I think you really got to take an industry competition look. Are you differentiating? Are you writing something that's outside of the sphere of what has been done? And do they put a price tag on that? And that's, I think, the sort of internal monologue that needs to happen.
And for how long are they going to put that price tag on it, right?
Exactly.
If it's an exciting area with a lot of demand, then competition is going to come into that space. And that's a good thing for investors. Maybe not so good for some of the issuers that are first to join the space, but that's a good thing for the whole community.
All right, so I wanted to move to another issue, which may involve people from the ninth floor, the investor track. One of the appeals of index funds, either for financial intermediaries or in qualified plans where ETFs, I think, from what I've heard today, are going, it's the old nobody ever got fired. Nobody ever got fired for picking a core index fund at a low price. It helps that generally they've gone up and markets have gone up and held steady and so forth. But basically you didn't really incur a fiduciary liability by picking one of the old standbys. So if you're not one of those, how do you deal with the fact that your customer may like what you're doing, they may think it's unique, or you might think it's worth the price, but somebody could come back and bite them and say, well, you had this obvious choice, but you decided to get a little fancy and you did this and maybe it didn't return the same amount as the big index. So you've done something wrong. How do you deal with that fiduciary issue or that customer issue?
I think it really comes back to the client. What is it that the client's objectives are? And if the client's objectives align to one of the major index providers, then yeah, absolutely, go on ahead. But if the customer, if the client's end objective is different, then the value or the success of the index or the fund will be aligned to the client's objectives versus the S&P 500 or the Russell 3000. And so, not to say there's not always going to be use for them. They're staples of the market, but if you are doing your fiduciary duty to ensure that the product that you choose for your client is fit for purpose to the client's objectives, you shouldn't have someone coming in and banging a gavel over you, telling you made the wrong choice by not picking the blue chip. The strategy is in and of itself needs to be fit for the objective of the end user.
Thoughts on that?
Yeah, I think the sort of, sorry, I'm struggling to find the right word for this. A lot of these fancier indices are going to start out as satellite positions. They're not going to be the core on day one, right? Maybe they'll grow into the core in 10 or 15 years, but it's going to take a while for whether it's a buffered product or a defined volatility product or a thematic product or something in the sustainability space, those things are inherently not going to replace the core allocation on day one. I think a lot of the marketing and sales efforts around them need to think both about how they work in isolation and how they work as part of a broader portfolio. Because I don't think there are many advisors for precisely the sort of reason you stated in the question, Paul, that are going to be going all in on a sort of more innovative kind of index with all of their clients' portfolio.
Mm-hmm.
I think it's absolutely real what you just said, and we see it maybe not every day, hopefully not every day, but it is true. Depending on which market you are working with, the headline risk is really high. Like if you're working with a pension fund, they're probably less likely to go with the no brand name than to go with an S&P or an MSCI. But when Mercube was born, we went out specifically saying, that's not the intent to compete with the big brands because it's impossible. So our idea was to work with the big brands because the things that we do, the big brands cannot do. So for instance, we work with FTSE Russell and we calculate some of the strategies that they can't calculate themselves under their brand, right? And we work with NASDAQ, same type of situation. So we have some technology that we have that they don't and they can use. When we have to compete head-to-head, S&P Mercube, it really depends on the investor and what they're looking to achieve, right? If you're looking for, as something that, is a staple, you're probably going to tell us, we'd rather go with S&P because it's a more, it's the brand power. But the brand power is real. It does help, and it's one of the areas that we need to focus on and to gather, more trust from the investors.
Yeah, no, I would say that, how do I put this? Yeah, no, working with an established player does have an advantage. It does convey a sense of permanence, a sense of continuity, a sense of reliability. That it's not going to shut down in 6 months. That it's going to be a going concern, and that is important. That does move assets. That really absolutely is an essential factor. especially when you get into very, very high levels of due diligence at large and established institutions. So having that track record, that discipline, that rules-based methodology over a sustained period of time, that absolutely is a factor.
And so you used the phrase due diligence. So when you talk to people, again, maybe it's easier to do due diligence on a broad-based index. You go, okay, price is good. It's tracking the index about as closely as it can track. Then we have your indexes. What's bad performance? How would I know? I mean, it's lagging one of these broad indexes. I think that's bad, but maybe it's keeping up with its own objectives. So what raises the red flag, or what causes me to put a fund like the ones you offer on a watch list, or to even consider withdrawing from a portfolio?
Sure. On the indexes that we've created, they each underlying security we are confident has passed through the traditional financial lens to ensure that they are performing well financially. They have the volatility that we're looking for, the risk that we're looking for before we overlay an ESG screen on top of it, before we overlay the intentionality screen on top of it. So if you're a stock in one of our indexes, we're really confident that you are best in class solving problems. And so if you are underperforming, it's going to be probably a sector issue or a market issue, and the overall basket of within that index may go down together or up together. And so really we see in our case, because we are looking to solve long-term problems, the indexes are long-term options for our clients. And so we do, if you wanted to be more of a quick investor where you pull out the second, maybe there's some headwinds, you'd be able to see based on the reporting on how well the index is doing. We track ours across a couple of different other metrics, and so we're looking at how the index compares to comparables, and we report that out as well.
I think it's all about the methodology and the transparency. And I think one of the great things about indices and index funds is that is all published. I become very skeptical when I read an index methodology that's vague and doesn't really say anything about what's going on. Right, that's a red flag for me if I'm evaluating an index or a fund. Yeah, we should look at past performance of the strategy, subject to limitations on what backtested data can be shown. You can look at the current and historical baskets that are held and ask, does this make sense for the methodology? But ultimately, I think there's a degree of comfort that comes from knowing that there is a rules-based process that's being followed. And you can read the rules, and if you like the rules, then great, go buy that fund. If you don't like the rules, well, then find another one.
Yeah, I would say that the way that an index provider, the due diligence that you do on an index provider versus the due diligence that you do, or an index versus the due diligence you do to an asset manager, is two different things. But in general, once you have the rule book, an index should perform to its strategy. How it performs compared to another strategy or another index, as long as it performs to its strategy and it's true to its rule book, then it's doing well to its strategy, right? In terms of due diligence, the due diligence we go through is more about systems, is data, is having the appropriate rights to the data, which is key, to make sure that you are, that your process is sustainable. And as you mentioned, that you're not going to be out in 6 months because you didn't have proper rights to the data, you didn't have the proper system, or a number of those things.
I'll absolutely echo that. A lot of the due diligence questions we receive, probably more than due diligence on the index investment strategy, is the technology around it and how reliable and robust that is, and maybe to a lesser extent the data entitlement side of it. But those are both huge topics.
And how about changes? So again, if you look at an active manager and something big happens, the bank crisis, 2008, they will say, as a result of that, we changed our strategy. We look at this sector differently, or looked at these stocks differently, or the way we price things differently. In terms of these strategies, I think sometimes when people think it's an index and it's a process and it's set, do you expect them to adapt? And how do you define the difference between adapting and overreacting? Oh, that stopped working, so we're going to switch to something else. But we're still an index. We're still rules-based. We just change the rules when we feel like it.
I'll jump into this. Generally, I don't think indexes should be changed, or they should be changed as little as possible. That's why they're an index. If you want to change it, it might be better to explore launching a new index and converting to that. But sometimes there are unforeseen circumstances. This year, it's been a market concentration and busting some of the diversification rules put on by the IRS and other fund requirements. And that has required a bit of a rethink of how we handle that. Do we put in cap limits on the 525 concentration rules? And how do you handle that? Do you switch benchmarks? Do you and we've had different reactions from all areas of the market as to whether we should cap the Russell 1000, whether and especially acute with the Russell 1000 growth. What should be done there? And it's interesting to see how this discussion plays out.
Other thoughts on concentration?
Oh,
things
not a
like
thought on
that?
concentration, but a thought on the first question
go ahead.
here.
Yeah.
Consultations, right? A big part of the way in which an index should change if the provider is following best practices, if they're IOSCO certified, or if they're registered with ESMA in Europe, is putting out a consultation and having a complaints form and making the stakeholders of the index, giving them an opportunity to weigh in on potential changes. I agree with what Ryan was saying that the change should be minimal, right? You shouldn't be making a massive change to an existing index. You should launch a new index to do that. But there are times that reasonably you want to change a data provider. You want to tweak the methodology a little bit. That should be something that the stakeholders who use that index can weigh in on.
All right. Questions from the audience? Do we have? There it is, the roving mic. Okay. Start here. You're first. Second. All right, please.
Thank you. Hi, Roby. I know we've heard a lot today, both downstairs and up here, about innovation. So I'm going to ask the chicken or the egg question. Should the index provider be innovating and coming out with the new indices, or should it be client-driven and a solution to what the client wants?
I would say that probably any index provider would say that 80% of their indices are actually clients' ideas, right? So it's a mix, right? I think that a lot of clients will go to index providers with their own ideas, relying on an index provider to put it in practice, and some of it can come out of the index provider as well, because you have such broad view of what people are looking for, what people are looking to build. So there is no reason why the index provider can't be innovative on their own, in addition to aiding the clients to get there.
Yeah, we, as an example of just that dynamic, earlier this year, we and actually maybe last year, we had clients who were asking about new ways to think about quality and market dominance. We sort of didn't have an immediate solution on that, but we took it back and did a little bit of research and came up with what we call our market share scores, which we then licensed to S&P, which they use as an input to one of the indices they calculate, the economic moat index, that First Trust runs. I think that's a great example of clients had this idea, a thing that they wanted. We were able to innovate on that idea and give to them a new kind of index.
Yeah, I'd add that the innovation on the index provider side is also really important, because the us in the kitchen with Syntax defining our indices that we've developed together was a unique situation, because we're the ones who actually know what the ingredients are, know what the data is available, and are able to, through that kind of inner workings, create an index that is quite unique and really, really innovative, that a client might not even know is possible to do today. And so I do think it is important for the innovation and the drive for new types of indexes to come from both sides.
Yeah, no, I would say indexers absolutely should be innovating, and we are. I think a lot of the innovation at indexers goes a bit unnoticed, whether it's reducing trading costs, reducing rebalance costs, all improving technology for just more research, for more exploration of where risks are in the market. A lot of that goes a bit unnoticed, expanding access to new markets. But also, it's just great to work with a client because you already have that first notch of commercialization checked off. So that's just great. It really smooths a lot of the processes in getting to market and getting to scale. Yeah, even as an indexer, getting to scale is still a problem. You have that chicken and egg in growing assets. And it's basically a problem everyone has if you're not working with the big three.
We had a question over here.
So really interesting stuff. View what you do as nimble, up and coming, and the perspective I want to start with the big asset managers. So if we think about the index providers, for academic reasons, decades ago, they would create the large, mid, and small, and then also the value, growth, and blend. And a lot of it was like the origination of factors to be democratized. And then the asset managers got pulled into it for economics, where you could see in one investor's portfolio one asset manager for the S&P 500, and then another asset manager for the 600, and then another asset manager for the 400. So the economics work out for the ratings agency or ratings provider, works out for S&P. Their SPIVA report is awesome, and it works out for the asset managers. There has been evidence shown that an investor, we're talking purely market cap weighted, an investor is better suited off if they just went total on a market cap weighted basis rather than did market cap weight at the 500, 600, 400. And even coverage is completely different. So I wanted to know about your thoughts on that, and then how you could be nimble if you were trying to persuade someone to go your route, to express a view and go something where it's like total, and then what you have to do, or if you disagree with it.
I'll jump in there. I'll say that it's not the job of the index provider and asset manager to basically tell the client how to invest. It's to give them the options, the toolkit to go and pursue their own objectives, because every client has different objectives. A pension fund, CalPERS is going to have a very different set of requirements from an advisory. And it's not our job to tell CalPERS how to invest. Sometimes they ask us, and that's great. We're happy to help them. And same thing with advisory groups as well. But it's a line we don't want to cross ourselves, obviously, as indexers. We don't want to tell people how to invest. Just give them the rules, the toolkit, because we don't want to invent. Yes, we don't want to enter the investment decision-making process. We provide all different options, and they provide different value propositions, different potentialities, different correlations, different periods of performance where they might have different return expectations. And it's the job of the advisor, wherever they are in the market, in size, scale, and sophistication, to make their own determination.
Yeah, I would say as an index provider, the one thing that you absolutely cannot do is provide investment advice. Otherwise, the SEC will be knocking on your door. So.
And just to add on top of that, I think that's one of the things that's really exciting about the growth of direct indexing, because I think direct indexing does provide a number of solutions to the challenge that you were laying out.
Yeah, and I think the way that we tackle that at 17 Asset Management is education. We create curriculums for advisors and their teams to understand what even is intentional investing. How do you think about assessing a thematic, whether it be a thematic index, whether it be a thematically aligned model portfolio? How do you compare that to other actors in the market? What are the kind of components to it that you'd expect to see, and then how would you think about applying a client's portfolio to it with the overlay of a modern portfolio theory? And so we really try to give the information back into the hands of those individuals who are making the decisions based on their client needs, or whether or not they're making the decision for our indexes to sit on the shelves of their firm for advisors to choose for their clients. And it isn't our job to tell them how to invest. Our job is to create a product that's best in class and that is easily understandable. And then if you're lost in translation, to provide the resources for that education.
I'll let that be the last word, but not necessarily, because you're welcome to continue this and other conversations at the reception, which will follow shortly. Yes?
Absolutely, and just want to say thank you to the index panel. Just a lot of energy and explaining these complex topics at the end of the day. So really appreciate y'all.